Well, thank you very much, and thank you to the Commissioner who really laid out the many challenges in a very concise way, and thank you to the two chairs for this conversation. It's a great conversation, very timely. Also for Madame Book, I believe that this is your first big trip to Brussels in this new capacity, so obviously I'm sure a lot of people are very keen to get to know you in more detail. And to start the discussion, I had an obvious question. When you look at the banking sector, when you look at the banking union, we're going to go in detail on that. Overall, how well functioning would you say it is in 2024 when it comes to Europe and serving Europeans?
Thank you very much for the question. Thank you very much, actually, Dominique, and to your whole team for having us here. So if I would cast a vote, I would always already vote in favor of this location also for the next time. It's very good to be here. So on your question, is the banking union working? And I think we've just from the Commissioner, we've basically heard it all, but let me just say it a bit in my words. And I think the issue is that we've seen, notwithstanding the shocks and the risks that we've seen over the past years, but we've really seen a resilient banking sector. So the banks are better capitalized, they're liquid. The cases that we've seen where banks came under stress, we had a system to deal with these cases of stress. And I think if you have a situation like this, it's sometimes forgotten how it would look if we didn't have all these new regulations, new institutions. So if you just think back how it looked 2007, 2008, when the global financial crisis struck, we didn't have harmonized supervision across Europe. So we had basically, of course, the same rules also coming from Basel, but we had very national supervision. We didn't have any resolution tools, resolution policies, a single resolution fund. I'm not even sure whether the term had been coined at the time. So what we could do, or what in the end policymakers had to do, is to really intervene into the financial system, to bail out the banks, to spend fiscal money that could have been used for much better purposes, to use it to stabilize the banking system. One reason was also, and that hasn't been mentioned so much, we didn't have macroprudential policy. It's not a term which, not a household name necessarily, but it basically means we didn't have any tools to deal with systemic risk in the system. And all this has changed. It has changed because a lot of policy decisions that we're taking in Europe, here in Brussels, why I'm particularly happy to be here. But I think it's always good to remind ourselves there was also a very strong international policy response to the global financial crisis. So the reforms that were put into place, the elements that were defined and that were then implemented, this all came also from the G20. The Financial Stability Board did a lot of work here. And actually, if, again, you think about what good this has done for the society, for the financial system, for the stability, you can actually look at the many studies that have been done by the Financial Stability Board, including on too big to fail, saying that we have a better system, we do have resolution policies. We also see evidence that the incentives have improved in the financial system. So smaller implicit government subsidies for the financial system. So all this is a big success. And in that sense, the banking union is working. And I think we also come to the gaps, but I just wanted to send a positive message first, and then we can discuss all the gaps. And I very much agree with the Commissioner, what she has said.
Certainly, that will be the follow-up question. But before, perhaps, also get your take, Monsieur LABOUREIX, on this.
Well, I can confirm very simply what Claudia just said. If we look again at where we are today, comparing the situation of today and 10 years ago, to the question, have we made progress? Is it working? Yes, the answer is yes, obviously. We've built a big amount of resilience because we had agreed, we, not us, but the co-legislators, on strong regulations applied to everybody, not limited to big banks only. When I compare the situation with the US one as an example, with proportionality, obviously, but still, so strong framework, strong supervision with a harmonized approach, strong and very new resolution framework implemented from scratch in less than 10 years. So yes, it works. By the way, it works, and we've demonstrated it with the small, still small, but this is good news in reality. It means that there are resilience in the system in Europe, but the small number of decisions we've taken, which were successful. Banco Popular, Sberbank, Banco Popular in 17, Sberbank in 2022, two completely different cases. And in both cases, due to the good cooperation, good preparation, all the steps taken during the last years, it worked. So to those who are telling me, yes, but are you sure that it's working? Yes, the answer, yes, it works. It can work even better. And this is exactly what Mary McGuinness has insisted upon, that's saying that we can indeed continue to close the gaps and to continue to be ready. And this is let's say, this idea on our side this time. With what we have today, we need to continue not to be complacent and to really be vigilant to improve our preparedness. So preparing the preparedness, but adding the elements which are missing, still missing, can even improve something which already works. This is, I think, the good approach to understand where we are today.
So you both have made clearly a case for the banking union. You both say it works, and you also say when you look at it objectively from 10 years ago, it is manifestively, or could be manifestly proven that it has worked. We're better off now than we were 10 years ago. So then my obvious question then as a follow-up, if it works so well and is so good, why is the banking union not moving forward, certainly not as fast as expected? It seems it hit a political wall and it cannot move beyond past a number of dossiers. So what happens next?
Well, I think one explanation for this, why we're not moving more, is, I mean, basically what I've mentioned already, that there's important, relevant elements of it which are actually working well, and we all know how it is in our daily life. So if things are going well, then the initiative and the energy to change things and to go another step are sometimes diminished a bit. And this is, I think, why it's so important, and also what we heard in the speech, that actually the times that lie ahead of us. So there's a lot of uncertainty geopolitically. We're in a very new macro financial environment, and we still, I mean, so far the banks are dealing well with it. We're seeing higher profitability, but all this is no assurance that it will stay like this. So we need to be very vigilant. We have to make sure that the whole system, the banks, each and every bank is well prepared, but also that we are well prepared. And as Dominique said, there are gaps still in the resolution framework. It's not saying that it's not working as it is, but there's things we can improve, and that, I think, is also quite natural. So when the regulation was drafted the first time, everybody did his or her best effort, and now we're finding that there's areas where it can be improved. And this is, I think, why the CMDI file is so important, because I think it will make sure that more banks are resolvable, that the necessary funds are there. This will have, again, positive implications for financial stability. And I think overall, the more credible the resolution regime, maybe the less likely it is that we actually have to use it, because that will also change the incentives in the system. So I think these are relatively straightforward steps. I really hope that this CMDI file is negotiated, discussed, and agreed relatively soon, because we really need this.
And Mr. LABOUREIX, on that point, the banking union obviously has to be completed. Everyone says it has to be completed, but it moves very, very slow. Some would actually say momentum, in fact, has been lost. How would you counter that?
Well,
if it can be countered.
When you say that it's moving slow, again, let me repeat, in particular on the resolution side. 10 years ago here in this European area, there was nothing on resolution, crisis management. The only ones in charge of crisis management at that time were supervisors. I was among those at that time, and we were managing at the same time the daily supervision of banks and thinking about potential crisis solutions. So we've built from scratch something completely new, with new concepts, a new framework, and we've started to implement it. So when you say it moving slowly, let's take the distance. The FDIC was created in 1933. So 90 years ago, 90, near to 1 century ago, we have created the resolution framework 10 years ago. And here there are two things which are always mixed up, and by the way, I just made it. We are mixing the framework, which is available to all the European Union countries, member states, including the ones who are not members of the banking union and the banking union. And when we think along these two lines, I think we have two avenues. What is missing, still missing in the framework applicable to the European Union, and what is missing in the architecture for implementing this framework within the 21 countries who have decided to be part of the same banking union. And if we go along these two avenues, on the first one, the framework, I think Mairead McGuinness said it very, very nicely, no need to repeat, you confirmed it, Claudia, we are entirely aligned. We need first to make some improvements, starting again from a good starting point, but we can improve it, CMDI. We've insisted already a lot on the core of the proposal, which is more regionally systemic banks for resolution than, let's say, increase of the solutions potentially usable for successful decision. But there are plenty of other elements around this core proposal which could help and ease the implementation of a resolution decision. So CMDI is one. EDIS, don't call it EDIS if you don't like EDIS, but this interconnection in a way or the other between the DGSs is absolutely crucial for completing the banking union, and even beyond the banking union, we also need to develop the capital market union. On the ESM treaty revision, this is specific to the banking union this time, and it's very, very needed to have this additional safety net to give more trust in our capacity to act. So on the framework, we have a number of things to do, but still we have achieved a lot. On the banking union itself, I would like to tell you that it works very well already on a daily basis. We are cooperating on a daily basis. There are here representatives of members of the teams we've built between SSM and SRM. We are communicating all the time. We're exchanging views on, let's say, normal cases and even on stress test cases, crisis times, preparing for decisions. We are working all together, and I would like to give you one or two examples of this good cooperation. We are visiting all the banking union member states together with Claudia and with your predecessor, Andrea. We've started last year to show that the banking union is a reality. It's not something, well, it's a reality. We are working together. We know each other. We are calling us every day, or more or less every day. We are sending us textos. We are working together. That's important to notice that. We are developing common templates, and you know, bankers, that there is this very good example on liquidity. Liquidity is a topic which is growing and growing as a risk today. So that's why we have this common approach. We have even developed new approaches for organizing exchanges of staff members between the two organizations to build this common culture. And we have started this year by sending different persons from Brussels to Frankfurt and from Frankfurt to Brussels. So, I mean, on our daily life, we're working together. The two pillars of the banking union are in place, working together. We expect to have a third one day or the other, but already the two first ones are working very well together.
And on that note, just to wrap on this issue, however, because you both have said, based on the way that I understood it, that you believe the banking union is a good thing, it is needed, and more work should be done. However, you know there's a number even of banking executives at times who say practically it is hard, something like EDIS, the political will is just not there for it, and maybe it would be better off to leave this aside and focus on areas where you could see material progress fast to strengthen the union. That may be the capital markets union. I wonder, is that an approach that you think is valid? Or actually, when you look at it, you say, well, it's Europe, everything is a package, and nothing is agreed until everything is agreed. How would you go about it?
I mean, let me first come back to the question of what are the gaps, and the gaps have been mentioned. So we mentioned CMDI, EDIS, liquidity and resolution, the ESM backstop. And I think one of the things that's perhaps sometimes a bit difficult to communicate, or where we have to do more, is that the idea is not to have all these funds that are available in resolution and in difficult times to actually use them. I mean, this is maybe a bit counterintuitive, but actually the more credible resolution is, the better we can threaten that in case, you know, a bank does not make it, a bank is failing, then we can deal with it. That, I think, has very important implications for the banks and for the risk-taking incentives in the going concern. So, of course, I mean, we as supervisors, we have to make sure that banks have good governance, good risk management, and all that. But we can't, in the end, it's not our role to prevent all bank failure now and forever. You know, there might be external shocks, and also we can't ultimately control what exactly bank management is doing. But we can make the probability of failure and the probability and the loss in case a failure happens, we can make that smaller. But all this, I mean, setting the incentives right in the going concern depends on that the banks also know credibly that we've heard about resolution planning and all that. This system needs to be credibly in place. And I think if we make this even more clearer and explain this, why it's so important to have all these funding facilities in case of resolution, maybe that will also make it easier to come to an agreement on these things. So we have very strong safeguards also when you look at the CMDI proposal. There's very strong safeguards as to when deposit insurance funding can be used. So I think there's a lot of maybe also sometimes misperception, or, you know, where we have to improve our communication about when are these funds going to be used. There's strong safeguards in the system. You also asked about all the other things that could be done to you know, enhance cross-border activity of banks. And let me say that actually I think CMU, so Capital Markets Union, is a very strong complement to all these initiatives, because there's a lot of very relevant aspects in this file. I just mentioned insolvency regulation, where it would be much easier also for the banks to do cross-border activity if they were dealing with not exactly the same rules, because we have differences in legal systems, but if they would be dealing with at least some harmonized set of rules.
And just to answer the question, maybe it's time to focus on things that are more actionable in the short term, or do you still believe it's a full package? This is not the time perhaps to give up on a part of it to focus on another?
I wouldn't give on any of these elements that we've been discussing here, but I think, I mean, we really need then to think about, I think, CMDI. I think it's a good package, and that needs to be passed. More work certainly has to be done on EDIS. I think EDIS is also crucially important, but I would do CMDI is really a priority. EDIS is important, liquidity and resolution, and then there's all these other files that are out there in terms of Capital Markets Union. And we also need to make progress there, also because we need to finance the green transition, and that also needs a lot of long-term funding. It can't all come from the banks, because there's a high uncertainty, and it's long-term investment that is needed. So that is, I think, the big political narrative also why we need the CMU.
And which is an excellent point that also both companies and banks say the need for funding is so huge, but the model as it stands may not be able to provide for all of that. It was maybe not made for that.
Well, I mean, this is why we typically have a good funding mix, no? Bank lending and equity finance, and there are many business cases where we need equity finance rather than bank lending when it comes to financing the green transition.
And I have a question for you both. In particular, I know, Madame Book, yesterday you put out a publication where you talked about the risks ahead, and almost your train of thought in terms of going forward, building resilience, but also things that could go wrong too. You just said a supervisor cannot prevent everything that is bad won't take place, but it can reduce the possibility of it manifesting. So I wonder, a question for both of you, in fact, when you look at 2024, the medium term, what are the risks that concern you? Are there new risks? Is the nature, even in banking supervision, changing? How would you say you approach this, and what concerns you at this point? Perhaps if we start with Monsieur LABOUREX first.
Well, Claudia is better placed than I am to speak about the current risk she is supervising with her teams. I think we agree on this very new feature, which is this sort of let's say, acceleration of the risk we are meeting. This is something which matters a lot for us, obviously, on the crisis management side, because what we've seen in the recent cases is that due to market pressure, a bank was able to collapse in a very few days, coming from, again, digitalization, which gives the possibility to organize a bank run very quickly, social media pressure, etc., etc.
That's a great point.
That means that for us, beyond the very classical risk, and I will let Claudia mention them, which are very serious, by the way, but classical credit risk, there are new elements which can threaten our level of preparedness. And I would like to insist, coming back to what Claudia rightly said about the need to make progress on everything. You said, is this something more pressing than something else? I think we need a lot of emphasis, because we need this flexibility, the toolbox, the full toolbox, to be able to address these new risks. The resolution framework, in particular the resolution framework, is coming from the analysis of the past crisis, that's to say 2008, 2009. And so in this past crisis, you remember very well, the source of the difficulties were essentially credit risks. So hidden losses, bad management of credit risk portfolios, and then, difficulties. So essentially, the framework was built on that one. The recent cases are telling us that the sources of the crisis can come from something completely different. Sberbank in 2022, sanctions taken by the EU member states against a bank whose, let's say, interests were owned by Russian oligarchs who were under the sanction lists. And then the bank failed in less than 1 week due to this sanction. Was it a question of solvency? Absolutely not. It was something linked to operational risk, reputational risk. What we have seen, as I said, in SVB is this sort of possibility to have an immediate pressure coming from real or fake news, we don't know, but creating a pressure for a bank run. So we need to adapt ourselves, and that's why, for me, not only there are these traditional risks, but there are new ones coming. I don't want to insist a lot on cyber, but cyber creates in itself new types of risks, new types of answers will be needed. I know that there's a stress test to be organized by you, and will be part, by the way, of this exercise, but I let you complement.
And you also, if I may say, you brought up the idea of social media, and that was for some very apparent in the case of Credit Suisse, because that was a bank that had passed the stress tests. Even hours before UBS had to come in, they still insisted the bank was solid and was operational, but it got caught in a very, to me, was very surprising as a journalist too, it got caught in a very negative zeitgeist that was amplified hugely in velocity in terms of the content, the narrative around it by social media. And that never stops, not even when the market is shut. So is that something that you factor in? You say it's new, it's strange, it's very difficult to control. How do you go about it?
Well, if you ask me, can I control the social media? You know the answer. Huh? Obviously not. We cannot control them. And it's certainly good news, by the way. Huh? Let's consider that they can bring value to the system, to our democracies, but they are also bringing some new risks, obviously. Huh? And so, regarding social media impact, so well, when we analyze, and some academics have started to study what happened in particular in SVB and Credit Suisse as well, we need to be careful in analyzing. It's not necessarily because you're connected to one of these social media that you will withdraw immediately your funds from a given bank. We've seen an enormous amount of stickiness in the deposits in the European banks in March 2023, despite all the social media noise around the crisis is coming, everything is collapsing, etc., etc. So we need to be a little bit careful. But what this implies, and coming back to something what Claudia mentioned a minute ago, it implies certainly from the banking system itself to pay due attention to this new potential source of reputational risk, and perhaps even more than what they are doing today, by being ready to, let's say the truth at the right moment, and counterbalancing the potential effects of bad social media elements could be something on which bankers should work even more. I know that they are doing it, but I think there is a part of the answer. The other part is for us. We are not equipped to be on the social media full time and disseminating 24 hours a day tweets and other things like that. But what we can do definitely is to show a coordinated communication, and this is important on both ways. Communicating at the right moment, peaceful time, crisis time, and this is part of the strategy, to communicate better, more transparently on what we are doing, what we are preparing, and coordinating between the authorities. And I think I give you the famous example, famous for the small community, in March 2023, when Credit Suisse AT1s were hit by this decision of absorbing the 16, 17 billion Swiss francs of AT1s. We decided, EBA, ECB, and SRB, to publish a common press release to say, sorry, but here in Europe, it won't work like this. And it had an immediate impact to counterbalance the fake news or whatever, or the rumors, to say, no, look, here we are ready to act in this way, not in that way. And it was extremely effective. So this is a good example of coordinated communication at the right moment.
Because the product is back. It didn't die. Some said that it would die, and it certainly did. And so I guess it also speaks to that, the communications around making this is not a European EU jurisdiction problem. But I wonder, Chair Book, to go back into the idea of risk, which perhaps is not always negative, but you have to deal with it. That's basically your job at this point. The playbook for the head of a supervisory board at this point, what does it look like? Because these are complex matters as it is, but yesterday, again, in this communications that you put out, you also talked about the huge geopolitical risks that are playing into all of this. Measuring that is incredibly difficult. On top of that, we've talked about some of the distortions that sanctions also provide. All of this put together, how do you go about this? Because it seems to me it's getting bigger and bigger, the portfolio that you have to attend to.
That's right, that's right. We have to look at a lot of different issues. And I maybe just make two big points, because you said geopolitical risks and measurement. I think one issue that we all have to be aware of is that we're dealing with a lot of uncertainties. And we know that if we're in an environment of uncertainty, some have even called it radical uncertainty, but that simply means that, it sounds very radical, but what it means is actually that we don't know exactly what's the particular event that could happen, what's the probability that we can assign to it, and what's the, in technical terms, the loss given default if one of these events hits. So I think what we have to be aware of, and we're also working very closely with the banks, is that not everything that we are interested in and that we would like to address can really be squeezed into a classical risk model. So we have to work with scenarios. We have to make sure that we have a very good understanding of what's happening at the macro level and the aggregate numbers. How does it break down to the individual bank? So that's the one part of our answer, that we, with all the different issues, uncertainty, risk factors that are around us, we need to be very clear that we can't measure all these things, and we also need sufficient buffers, again, to ensure, for instance, against cyber attacks. So this is nothing we can, it's not only capital that's important here, but it's also IT resilience and all that. And the second point, and basically Dominique said it, we do have a new environment, and I don't have to give all the, the elements of this here, but we need to adapt to this new environment. So we have very, very good teams, we have very, very dedicated supervisors, and the system is really working very well. And now I think we need to look ahead and think, and this is also what all the banks here in the room also have to do, to think about to what extent will the new normal look different, and maybe we'll never reach a new normal, but we will be in this situation where we keep facing new threats and new situations to deal with. How different will that look from the recent past? And the recent past, again, we had severe shocks, COVID, the Russian war against Ukraine. I mean, these were shocks that hit our economies and our societies already. But if you look at what happened to banks' balance sheets, because we had a lot of fiscal support and we also had accommodative monetary policy, the balance sheet of banks, luckily, were not hit by these shocks so much. But this is, of course, makes it difficult to do the risk assessment going forward, because we can be relatively sure that with all the constraints also facing fiscal policymakers, they won't be able to give the same type of support within the same magnitude to the real economy. So there will be more fragilities also that may hit the banking sector. And also the liquidity environment has changed. I mean, central banks have moved from QE to QT, so from quantitative easing to quantitative tightening. That means liquidity risk management is much more moving to the forefront of our work and also the work of the banks. And we're doing, of course, a lot of work working with the banks on their funding plans, on their liquidity planning.
And on that front, you obviously mentioned the changing monetary policy. I'm not going to ask you what the ECB will do in March and where that's going, but it's obvious now that interest rates, to some extent, have peaked, and the question is what happens in this new scenario. For banks, that is now the story. The idea of higher rates and benefiting their business model can only last so long, and some would say it's not even a real business model, that cannot be your business model. But how do you think this is an area that can be, well, managed in the context that monetary policy does have an impact on financial institutions, and it is changing and will change this year? That's not a secret.
Yeah. And even if you may ask, I wouldn't answer any questions on monetary policy, so that's easy. But I mean, the interesting part of the story is if you look back like the past 1 or 2 years, we had a major increase in interest rates. So I think in most of the models that we've been using, that would have been an adverse scenario. So you may say the adverse scenario of some of our stress test analysis has become reality. And of course, the impact effect on the financial institutions has been positive in the sense that we're seeing higher profitability because of higher interest rates. High interest rates, of course, were the response to higher inflation. So far, I think the system has been able to deal quite well with this higher interest rates. But what it means in the longer term, so we've been discussing deposits, so far we haven't seen a pass-through of higher interest rates onto deposit rates as we've seen it in the past. So that remains to be seen, how depositors would behave, whether they would move more from sight to time deposits, which would increase the funding cost of banks. What the higher interest rates also do to the corporate sector, because we have, I mean, this is not a general issue for the corporate sector, because also many firms are quite solid in terms of their funding situation. But of course, there are pockets of vulnerability, in particular, if high interest rate exposure, high debt, plus exposure to higher energy prices comes together. So these are the things we're looking at very closely. So what I want to say is that we have seen a significant increase in interest rates, and we need to understand collectively how this feeds its way through the financial system.
And can I just ask you just very briefly, obviously, since there's bankers here, and I'm sure they want to hear this from you, it's February, obviously, it's that time of the year. Just to get to know you a little bit better, when you look at maybe remunerations for bankers and so on, is there a line that you're going to take as the chair of supervision? Is this something that you're actively thinking about? Because it is part of your duties at times if you believe something is excessive or not. So how would you go about that before we move to the next part of the debate?
Well, I guess, our policies are very clear. No, we have clear capital requirements for the banks. We have quantitative and also a lot of qualitative measures. We haven't been talking much now here about governance and business models and all these things, but we have very clear guidance, expectations, capital requirements for the banks. But then, of course, each and every bank, each of each and every manager has to consider what are the risks lying ahead, what preparedness do I need for my institution. So this is a decision that we can't take for them, and that also means looking at the capitalization, the management buffers you want to have, looking at IT systems, what is the resilience of the IT systems with regard to cyber risk. So I think this is actually at the very current moment with good profitability numbers, it's a good opportunity actually to build resilience, and this is also my encouragement for everybody who's taking these decisions to bear that into mind.
Well, you made that message clear. Mr. LABOUREX, you talked about the coordination that you have with other European institutions. In some cases, that was, well, not the reality. There were a lot of silos, and communications was not as good as it could have been in some crisis situations. How fluid would you say it is now? And when it comes to, well, the financial sector and the banks and the entire ecosystem around it, there's usually some tension between the regulator, the supervision, and the other side of the equation being the banks. How fluid is all of this in 2024, would you say, and what can be improved, if anything?
Well, let me say that by essence, to ask bankers to pay for their own potential resolution is not an obvious message to pass. And I must say that the communication is necessarily a difficult exercise. So, the equation we try to show is that indeed by increasing the resilience at a cost, obviously, in reality we make the crisis remote, and this is exactly where this resilience has a positive price, and it was acknowledged in March 23 when the crisis stopped at the borders of the banking union and more broadly the European Union. Well, perhaps there were other explanations, but at a minimum this one is extremely relevant. So in terms of communication, when we launched the strategic plan, we launched a survey regarding the industry, and we received exactly the three main messages. You are not transparent enough, so we don't know what you're doing. You do not associate us sufficiently well, and we receive your letters asking this or that, and you don't let us sufficient time. So to implement what you want. So, okay, building on these three things, you're not transparent enough. Well, we try to be more transparent, and as I said, we've published last week all the request surveys, etc. we will organize during this year. We are offering today the possibility to have exchanges, and we want to continue to be more transparent on our topics, which are obviously of a lot of relevance for the banking industry. You don't give us sufficient possibility to react, to be part of your thoughts. Okay, we've launched this Emerald survey. We've let 2 months for collecting answers and to analyze them, and we promise to continue with other consultations on what we are doing, and we'll have other formats to be sure that we can discuss together about these topics. And you don't let us sufficient time to implement, as I said, with this publication ahead of what we expect the bankers to do in 24. This is the beginning of an answer. In a nutshell, I want to increase the relationships with the banking industry, because it's important to understand that the so-called resolvability, sorry for this jargon, means in reality a lot of work for the banks themselves, also for us obviously, but for the banks. And coming back to what something Claudia just said, with this high level of profitability, that's the right moment to think long-term in terms of investing sufficiently in IT systems in particular, to be ready to deliver on our expectations for being ready for resolution. So again, it's not an easy way of thinking to say, well, why should I spend money for my own potential crisis failure? that's the best way to avoid it in reality. And that's why we need to have this strong dialogue to improve our common understanding around these notions. What we are doing is exactly increasing resilience, as the title of this conference says. Increasing resilience means to have a strong and, let's say, shared dialogue between the industry and us to be sure that we are on the same page.
And Chair Book, how about you? Because from where you sit in Frankfurt, obviously you have to work with these institutions and they have to work with you, but inherently there's always a tension between the two, and you have to watch out for rules that are applied and have them applied efficiently, but banks also say, I have to do that while also making money. So it's at times a stressful relationship. How would you say you plan on approaching this? What kind of communications do you want to have? And as it stands, and obviously you took over from Ms. Enria, what legacy do you have in terms of the fluid communication with institutions?
Okay.
Did they welcome you? I guess that's the question, openly saying, yes, let's work together.
Well, that's, you have to ask them. So far, I think our interactions are very good and positive. So also in the process of getting to know each other, of course. I mean, I think there's one important element that you mentioned that was very high on Andrea's agenda, and it's exactly what we are doing now, and what is also my priority, namely to be very transparent about what we're doing. So, like you said, it's, I mean, quite natural that the supervisor and the bank that's being supervised don't always have exactly the same objective function. This is perfectly fine. This is why we are there. So we also have to take a bit more of a longer-term perspective. So we know that a lot of decisions are also driven in banks, are driven by short-term risk responses to market development. So we have to look through these shorter-term trends a bit and really look at also the sustainability of business models in the longer term. This, I think, in the end, is also in the interest of the banks themselves. So there's areas, of course, where we also have to consider more what's of interest for the society, whereas the bank, of course, has to look at its own shareholders. But we need to be very transparent about what we do, what our objective function is, what we expect from the banks, what is our supervisory guidance. And if you look, for example, what we've done now in the area of climate change and environmental risks, I think we've set out very clear expectations, supervisory guidance. We follow up upon these expectations so that the banks know exactly what we're looking for and why we're doing this type of work, not because we want to replace climate policies, but because climate risk is a real and material risk for the banks in terms of transitional risk and physical risk. So here we're working with the banks, and we also set clear expectations, and we also say, well, look, if these expectations are not met, then we will also use our different supervisory instruments to actually enforce the decisions. I mean, this is only always the ultimate instrument if we use, for example, sanctions and penalty payments, but this is really the guidance, the transparency that we give to the banks.
And that's a very good point, because and this is in a way some of the tension at times that you see to when it comes to the banks and the regulator. You just mentioned, for example, climate and how to apply that into supervision and regulation. Some would say it is making the field too crowded. The ECB actually does not have a mandate for climate. Its mandate is to, well, have price stability and obviously look after banks in the transmission of that. So all of this makes supervision perhaps too crowded, and it's not helping. Would you say that approach is wrong? Ultimately, risks in the future will manifest in different ways, so you have to also look into this. Because you know the critics will say, you put too much on the plate.
Yeah. No. I mean, we're acting exactly within our mandate. So there's very good supervisory reasons why you want to deal with climate risk and transitional risk, physical risk. So there's an interesting survey we did, and we're actually now repeating it, asking the banks, how well are you able to deal with novel risks that lie ahead? And this is the whole spectrum of geopolitical risks, so things that are that weren't on the radar, let's say, a few years ago. And one of the elements is climate and environmental risks, and most of the banks that we asked didn't have an appropriate monitoring system, I mean, very basic data infrastructures in place to deal with these risks. And this is exactly where we start. So it's not like we want to impose our own preferences as citizens onto the banks in terms of climate policies, but it's rather saying risks are out there and how are the banks dealing with them. And since these are novel risks, there's more discussion that is needed on what do the banks need, what information systems do they have in place. And these are actually areas where we do find deficiencies, not only with regard to climate, but also we find other deficiencies in the internal information systems of the banks, and that's exactly where we follow up. And this is at the core of our mandate.
And Mr. LABOUREX, would you agree with that, or do you sometimes see the flip side, that perhaps supervision is doing its job but maybe extending its mandate a little bit too much? Obviously, from where you sit, I guess that's not going to be a yes answer, but
no.
I have to ask you the question.
You should not ask me the question, because I was a supervisor before becoming the chair of this institution, so I think a good involvement and understanding of the supervisory issues. What Claudia is telling us is that we need to think long term. We need to look forward, and this is exactly what we ask bankers to do: capital planning, envisaging the unexpected elements which can threaten their business model, profitability, organization, etc., etc. So from that perspective, no, I don't think that the SSM is doing too much. To the contrary, I think the SSM is exactly at the right place. That's to say, not enough to rest on our laurels. That's to say, we have a good system for validating internal models. We have a good system for following some risks, credit risk, market risk, etc. All good, but we can still make progress. And still, we need to address the new threats which are developing short-term, mid-term, and long-term. And for us, it's very, very important, because building resilience means indeed to be able to withstand let's say, the shocks of the daily life. Then resolution enters at the moment when the shocks are so unmanageable that we have to consider that the bank is failing, and then we have to protect the financial stability. But the better the risks are addressed in what we call a going concern mode, the better for the overall resilience, obviously. By the way, by adding this resolution preparedness level to the banks, we also bring an additional level of resilience in the system to be able to tackle potentially unexpected situations. So I think our role today is indeed to continue this monitoring of the risks and monitoring the adaptation of the business models, governance, risk controls of the banks for good days, but also for crisis times. And this is exactly what we are doing together.
And before we started, I was actually having a conversation with someone outside, and this was a person that works in the private sector. And we're talking about regulation, and one of the themes that came up is you can have a very good playbook, but if you look maybe perhaps to the past 10 years since the financial crisis, and this speaks to perhaps the good value of regulation, you haven't had major incidents. You mentioned Banco Popular, but relative to size, that was a small incident compared to other institutions that we saw play out outside of European jurisdictions. Are you confident of that? If that were to happen, you would have the agility and the capacity to translate what looks good on paper into actual real-life implementation? Because I guess many here would have to do the implementation of these rules. Do you trust it looks good on paper, but it's also operationally well?
I guess. I mean, let me maybe answer this question a bit more broadly, and also, I mean, remind everybody of an exercise we're currently doing, and I think Dominique mentioned it. This is the cyber resilience stress test that we're currently doing. So why are we doing this, and why I think it's also in the best interest of the industry to do this, because we will have information that we gather from this exercise that we then also feed back to the industry. So we do this cyber resilience stress test to understand how would we respond, what are all the things we have to do, all the stakeholders, how do they have to communicate, what redundant systems do we need in case a big institution is hit by a cyber attack. So would anybody think that, if a cyber attack hits, that we have then an exact playbook that we can follow, and if we just follow this playbook, everything is fine? So certainly everybody would say we can never exactly plan the next crisis, but I think all we can do in quiet times, and here it says risk readiness and resilience. I think the readiness part is very important, because we don't know where these risks are coming from, we don't know where the cyber attack will hit, but the better we are prepared, the better we will be able to also to deal with this situation. And this is why I know this is burdensome for all of us, all this dry run and these crisis exercises, and I'm sure this is also being done in all the institutions that we have here represented in the rooms. In the room, I know that people sometimes feel like, well, we could do other, day-to-day work, which is more important, but I think we really need to do this preparation, because it's only then that we understand where are the frictions in the system, where's very simply the person that doesn't know whom to call in case of a crisis. So this is why we're doing all this, and I think we are very well prepared, but of course nobody can give you the 100% guarantee that, how the crisis would play out and what we would do then.
Yeah, indeed, it's at the core of this new strategy. That's to say, we've built the bricks for building this resilience, but we need to be sure that indeed we can use these bricks when and where necessary. So that means that we need to test even more, to implement different tools, asking banks to show us that they are able to find the right data at the right moment, etc., that we are ready ourselves. And here there's a continuum. Banks should be ready for their own crisis. This can be seen as very, very strange, but in reality, this is exactly the story. If we want to implement a successful resolution decision, banks should be ready for their own potential failure. What does it mean? It means that banks should be ready to give us immediately all the elements we need to implement the decision. If we decide to sell the bank to somebody else, or the assets and liabilities to somebody else, we need to build a data room immediately. If we want to implement what we call the bail-in tool, we really need to know the owners, the instruments, where they are, the jurisdiction of a registration, etc., the CSD, etc., etc. So all these things should be in place. The best thing to do is to test that they are in place. So this is for the banks. For us, single resolution mechanism. We decide in Brussels, but the implementation is for the national resolution authorities. So that means that the national resolution authorities should be ready. That's why we have developed this notion of what we call the handbook, the national handbook in each and every jurisdiction. This handbook should be fit for purpose, that's to say ready to be used tomorrow morning to implement the next decision we could take in case of a failure. We have obviously an MOU between the SSM and the SRM to tackle all the nitty-gritties of a communication at the moment of a crisis. This is tested regularly. You can tell me, okay, all good in Europe, but what are you doing abroad? Because banks are international ones. We are doing exactly the same things. So in April, we have a new round of stress test with our colleagues from the UK and the US. This is called the trilateral exercise. So we are simulating a crisis, a cross-border one, and we are testing some elements of a framework. Who would take the decision, who would communicate, where the liquidity could come from, etc. And we are gathering the authorities from the European Union, Banking Union, the UK, the US. So just to give you an example of what we are doing, we are preparing ourselves to tackle the potential difficulties. And this will be at the heart of the new strategy to increase even more this level of preparedness and tackling all the difficulties. We will find two elements which were not yet mentioned, and perhaps that's a good occasion to come back to the regulatory framework. By testing all these things, we will find two things. I already know them. One of them is that when we implement resolution, we have also to compare the benefits of resolution compared to national insolvency rules. And here there is no harmonization, neither in Europe nor between the different countries elsewhere around the globe. And there will be a moment when there will be a need to find more harmonization inside Europe at a minimum, and perhaps even more. There is an initiative taken by UNIDROIT working on this one. And the second element is that once we have something entirely ready, entirely tested, we need to look outside of the banking sector, because there are a lot of interconnections between well-regulated, well-prepared institutions and others which are less prepared. And I have in mind, obviously, what we call the non-financial banking institution, the non-banking financial institutions, sorry, NBFIs, which are at the heart of some recent events, not March 23, but previously. We've seen that there could be contagion between this less regulated world and our banking world, and I think we need to foster the work for better regulation and better rules for these less regulated institutions.
And we're running out of time, but before I put the final question to you both, I do want to ask a question, go back to your book, because you mentioned this yourself. You said in terms of regulation, there's also the question about the medium-term business model and the long-term view. Some would argue one of the best, or possibly the top line of defense for banks would be to have a solid business model that allows them to have profitability and make money. If you compare them to peers, let's say in the US, you could argue they haven't really gone to the full potential that maybe European banks should have to compete as global players. Is that something that worries you, concerns you? And would you believe, or would you say, if there were less European institutions, if you would see cross-mergers, big European champions, this has been in the debate for years and has not manifested. But if it were to manifest, would that lead to a stronger, more solid financial sector and ultimately make the supervision easier for you? Is that the way that perhaps in the future it could look? Or is it more nuanced?
I mean, first of all, I was a bit hesitant to really compare the US to Europe, because the markets are very different, the traditions of the banking systems are very different, and we also see this within Europe. So we have, I mean, the countries, this is why actually the joint country visits are so interesting, because we see that we have, across the different countries, we have very different market structures and various, many specificities of the national market. So that's something we always have to bear in mind. So do we have a vision? Do we as supervisors have a view on, what the structure of the banking sector should be? And the answer is no. I mean, this is really, I mean, these are again also business decisions of the individual banks, whether they want to merge, whether they feel that, they have comparative advantages compared to other institutions, and what do they want to do with it. I mean, what we have to make sure is first that regulation and different regulatory supervisory practices won't impede any, cross-border activity. And this is, I think, where the single supervisory mechanism and also the whole system that we've put into place, I mean, we have also oversight over the less significant institutions where this is so important. So I wouldn't buy into the argument that it's because of supervision that there's no cross-border activity or less than what one would maybe expect.
Although they do say that doesn't fully happen because the full framework is not there yet. And then that becomes a regulator story. So it's a circular story, but you say you don't fully believe that.
I don't think you can blame, supervision and the single supervisory mechanism and the rules, because these are the same for all. But as we've said, I mean, we've heard about many things. There's many, many differences across European countries, and that has also an impact on, the market positioning of the different banks. So, but if clearly, and then if there are larger institutions, because you also alluded to size, then of course we need, we have also our tools to deal with the risks that are also imminent in larger financial institutions. That's also something part of the equation.
And now the final question for you both. Well, you're going to be working together clearly very closely now in the future. I wonder, what do you hope comes out of the relationship of your two institutions? And for 2024, if you could just pick maybe one, what's top of your pile of dossiers or issues that you want to focus and say, in 2024, I have to handle a lot of things, but this is top priority for me. What would it be, respectively, for you two?
Well, for me, the answer is fairly simple. For me, the first priority is to launch this famous strategy, first year of the strategy, which is extremely ambitious in reality. So it will be a long-term one, a 5-year one, as we've said, but nevertheless, we need to launch it in all the dimensions. And in particular, the first one, the core business, that's to say, this shift from a planning, building the key and initial elements to testing and to be sure that it works. So that means a lot of changes internally in our relationships with banks, internally with our teams. And this is clearly the goal. My main priority for this year is to be able to implement completely this new approach and starting building this new culture around the lines of this new strategy. So for me, this is priority number one. And my priority number two will be to continue developing very good and strong relationships with the SSM on a daily basis. It's already the case, but let's even continue deepening them.
No, I very much agree. I mean, it says it all: readiness and resilience. So, I mean, this is really it's hard to pick this thing, the one deliverable or the one item that's particularly important. But I mean, this is what we're working on jointly in a very good spirit.
Something, a pool of risks, something that you say, this is where the attention is at. There isn't a concentration anywhere for you as it stands.
Well, no, because we have many, we work together actually on all levels. So we haven't actually mentioned there's also a lot of swap programs and all that. So our teams work together very well, but we have to be very alert to the environment around us. So it's less of what we think is important, but what the environment is demanding from us.
Well, thank you very much to the both of you, and you've been very kind with your time. So thank you for this, and we look forward to the rest of the conference. Thank you very much.
Thank you very much.